Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by Janus Henderson Investors. As such, the sponsor may make suggestions for discussion, but final control remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Jay Sivapalan, who is the head of Australian fixed interest at Janus Henderson Investors. And today we're going to talk about the 2023 Australian Insurance Report, a survey of Australian insurers and their thoughts about their investment portfolios, how their investment outlook might change, and what changes they are considering in the next 12 to 24 months. Jay, welcome to the show.
Thank you, Wouter. It's very good to be here, and certainly an exciting time and an important time to be having these discussions specifically for insurers in Australia.
Yeah, so can you tell me a little bit of the background of this survey? I don't think this was the first year that it's being held. It has a bit of a tradition, and it covers a wide range of insurers.
Yes, we conducted this research with over 25 insurance firms here in Australia back in July and August of this year. And our aim really was to gauge the sentiment amongst Australian insurers, how they're thinking about their investment portfolios, how their investment outlook might be evolving, and what changes they're really considering over the next 1 to 2 years. And to the best of our knowledge, it's really the first solely Australian focused survey designed to understand what insurance here are thinking in terms of their investments. And we had, a really good participation across the industry. So the participating firms represented a broad range of Australian insurers, whether it be life, general insurers, health insurers, as well as other not-for-profit or other insurers as well. And the responses were really from those most senior leaders in the insurance industry, sharing their insights with us, with, 1 and 2 respondents who were C-suite executives, so CEOs, chief investment officers, and CFOs. And as you're probably aware, the insurance segment is a core part of what we do here in Australia at Janus Henderson. And we've got some in-house actuarially trained investment personnel within our fixed interest team, and also solution specialists who've spent most of their careers in insurance here in Australia.
And I think one of the interesting parts, one of the conclusions of the report was that 9 out of 10 insurers are revisiting their SAA. Is that purely a product of the increased interest rates, or what is driving that?
Yeah, I think if you take a step back and really look at the global investment landscape today, compared to the decade leading up to the pandemic, and of course that period during the pandemic, it has fundamentally changed, both from a structural perspective, as well as, to your point, from a valuation and perspective in terms of risk-free assets and bond yields. So on the structural side, we all know that, the world is going through quite a different period in terms of the reversal of globalization, the big climate adaptation and the costs of those climate adaptation, and then, of course, the geopolitics that we've been seeing more recently. So it's quite a different environment to, I would suggest, that period in particular from the GFC to the pandemic, and again, different to the period leading up to the GFC. So the macroeconomic environment has really led to 9 out of 10 insurers revisiting their strategic asset allocation. And half have already undertaken this review, and the remainder are in progress or intend to do so over the coming year. And the top three concerns for insurers we found, and what was leading them to reviewing their investment strategy, were rising interest rates and risk-free rates. Of course, that is very closely tied in with inflation, and then the changing forward-looking expectations that I mentioned. And all of these have different impacts for each asset class, whether it's investment grade credit or higher risk segments like equities, property, infrastructure, and then the private side of things.
And I think a lot of insurers already indicated some of the changes that they potentially might be making. What are some of the asset classes that they're looking at?
Yeah, this is where the data gets really interesting. Across the board, we saw 1 in 3, or 37% actually, of insurers looking to add risk to their investment portfolios. But that number rose quite a bit more, almost half of all life insurers, so 47%, looking to add risk in one way, shape or form. Insurers do continue to expect that their largest increase in allocation to be to domestic government bonds. And that is a function of two things. Firstly, a sharper focus on asset liability management and matching. And so that's about 34% of the respondents. But secondly, to your earlier point, government bonds today at yields, not far off, or very close to 5%, is a very viable return alternative as well to other assets. Private debt is a second component, remains to be in vogue and in favor in terms of looking at solutions to add into insurance portfolios. And then, of course, Australian investment grade corporate credit, about 29% of respondents shared that they'd like to increase their exposure to that segment. And probably the one area that remains quite polarized in terms of intentions is cash, good old cash. Now, cash, as we know, these days is no longer worthless. It does provide a pretty good hurdle or benchmark for every other asset class from there. And so we're seeing an increase in allocation to cash, about a quarter of respondents there, and a very similar number looking to decrease their allocation to cash, pursuing other assets like the ones that I mentioned.
Did that finding surprise you, that they're taking on a little bit more risk? Because, you would think with bond yields being higher today and sort of an outlook of more volatility and potentially lower equity returns, you would think that maybe this is a time to go a bit more defensive and add a few more bonds.
Yeah, and I think it really depends on where these insurers are in their own evolution. As we know, the life insurance space with long tail risks got a well-embedded asset liability management program, and they have gone through that journey of ultra low cash rates, ultra low bond yields, and coming out on the other side. And so many of them have already taken on, private debt and other alternatives, infrastructure, etc. Some are still in train in adding some of those exposures. But then you look at other segments like health insurance, who are moving into the LAGIC framework, APRA's LAGIC framework, and perhaps are looking to de-risk, in particular, the capital impost from their existing portfolios that may not have been that capital efficient, and really now focusing on, the cost of that capital and then what are the most efficient return on capital that you can get.
Yeah, so you see that they are now subject to the capital risk charge. So that has led to a bit more conservative in their portfolio?
Yeah, I'd say that most health insurers who will be moving on to the LAGIC framework, they have either started their work looking at their portfolios, working with, in the case of asset consultants, working through with the asset consultants and so on. Some are starting to make that transition, but I think the real transition will come over the next 12 to 24 months.
Yeah. Now, one of the asset classes that a lot of insurers look to allocate more to was unlisted infrastructure. What is sort of driving that? Is that they were underweight in that sector, or is that more the outlook for the asset class itself?
Yeah, depending on the type of insurance company and also their ownership structure, insurers historically and globally do have the ability to take quite a longer term view. And also, especially when you're talking about long tail risks, they do have the ability to take liquidity risk as well. And so assets like infrastructure, which are long tail, less liquid, but if there's a return to be had, that might be quite an attractive area. And I think that's one of the reasons why some insurers are looking and extending into that area. It is a bit more capital intensive under the LAGIC framework. So insurers have to effectively balance that versus the return improvement. But I think the assessments that we've seen from some of the insurance companies is that they do have a marginal preference for that versus broader equity market beta and all the volatility that goes with equity markets. The other thing also is that it can be a proxy or a dirty proxy for as an inflation hedge, especially if the liabilities have some form of inflation that can't be easily replicated in an inflation-linked type portfolio. And then something else that came out of the survey is that insurers really do have a focus on capital and profit volatility. And so when you're talking about public market assets, whether it's growth assets like equity, listed property, etc., infrastructure may be a little bit less volatile, both on the profit side as well as the capital side.
Before we saw sort of the rates rising, there were a lot of insurance companies that were looking for bond replacements, and some of them moved to a bit more of an exposure to alternatives. Could we partly see that as a driver as well for this allocation to unlisted infrastructure, or is that a separate issue?
Yeah, certainly the experience of, in particular, the last 3 years leading up to the rise in bond yields of more recent times. But I would even argue that period from about 2015 to 2019, when Europe and other central banks were still experimenting with 0% cash rates, negative bond yields, and so on. It was a really difficult time for insurers to get decent returns from their risk-free or lower risk, fixed income type assets. And so you needed to chase returns from other sectors, and it was pulling a few levers. It was pulling the illiquidity lever, it was pulling the credit lever, and it was pulling other infrastructure alternate asset type lever. They were the three levers that insurers were typically pulling. Today, I wouldn't say that insurers are spoiled for choice, but they certainly have a lot more choice now that bond yields have more or less normalized, whatever normal looks like these days.
Yeah.
I think the hurdle or the benchmark to pursue those other illiquidity or more complex or alternate asset classes is higher today, and insurance will go through that, process of certainty, capital volatility, and profit volatility versus taking on those additional risks going forward.
We're still in a very volatile environment, and earlier this year there was still a lot of talk about a recession. I think there's less talk today about a hard landing. But you asked as well the insurers what their thoughts were around a recession, and it seemed that life insurance were the most concerned out of all of insurers about an upcoming recession. Why do you think that is?
Yeah, so when you look at the typical balance sheet, in particular the technical reserves of a life insurer, they tend to have a beta bias and typically a credit beta bias. In some case, it also includes asset-backed securities, which are a bit more consumer cyclically exposed, housing related, RMBS, and so on. And so the survey, I think, to us demonstrated that is a heightened level of sensitivity towards the tail end of an economic cycle. Now, it's hard to tell whether we're at the end of an economic cycle or approaching it, but I think we can all agree that we're more progressed through the economic cycle. And so credit beta is something that is very relevant for insurers to think about, in particular long-tail life insurance companies. But there are also some solutions around it, and we've certainly been working with some of our insurance clients around tail risk hedging, if it's proxy hedges and so on, using the CDS markets, looking at options markets and so on, and really to manage that tail risk rather than necessarily divest out of that area, because insurers still need to make a good return above and beyond their liabilities.
Yeah, so can you do that tail risk hedging without sort of blowing out the costs for managing that tail risk?
Yeah, so like everything in life, you want to be buying protection when no one else wants it. And of course, the more volatile a world looks, everyone wants protection. What we have found is that we have been able to do a few things. So the first one is within the credit parts of insurer portfolios, you can certainly skew the portfolio more to the defensive, non-cyclical, non-housing related sectors. And so that's to us step one. Step two is that for much of this year, the calendar year 2023, physical credit spreads have remained more elevated than CDS credit spreads. And so it's been we wouldn't say credit protection has been cheap, but it's certainly been less costly and has made sense to pursue good corporate credit spreads and then offset that with some level of CDS protection. And that is something that we've been doing for insurance clients. On the other side, duration mismatches, in particular long duration, now that fixed interest has become more of a defensive asset class with yields having risen, that's another area that if insurers are comfortable, worthwhile taking on as a proxy hedge for credit beta.
Yeah. Now, we started talking a little bit about the reviews of the strategic asset allocation. And of course, that ties in with, what the actual objective is that insurance investment teams have, because it can be quite different than, say, a superannuation fund or another institutional investor. And I think the report outlines three main objectives: regulatory capital stability, return seeking, or minimizing profit volatility. Is there sort of a correlation between any of these three objectives and the type of insurer they are, like life or health or general?
Yeah, so probably the first place to start is, what is the nature of the insurance business? What is the ownership structure? So if I start with the ownership structure, where you've got listed insurers, clearly they're much more sensitive to share price and share price movements versus a subsidiary of a global insurer where they're a lot more interested in repatriating dividends or capital back to the parent, all the way through to the not-for-profit and or government, segments. So that definitely plays into how much profit volatility an insurer is willing to absorb in terms of their strategic asset allocation, especially in a risk-off type environment or a stress testing that they would undergo. On the regulatory side, that's almost a non-negotiable for most insurers. The last discussion that any insurer wants to be having is with APRA around, an inability to have sufficient capital around their assets. So the regulatory side is more around the buffer against a minimum amount of capital, and then how to make that capital as efficient as possible and make the technical reserves as efficient as possible. And so we spent a considerable amount of time effectively building portfolios for insurers, marrying the LAGIC capital requirements with the return outcomes, and then stress testing those for adverse scenarios, and just proving out that even under adverse scenarios, the likelihood of having a very difficult conversation with the regulator is quite low. And that's really key. And then the last part, around return seeking, again, there, if you're a, long tail, insurer, depending on your product line, whether it's life insurance or TPD or something like that, or workers' compensation, clearly you've got an ability to take some risk to enhance returns over a very long period of time. Whereas if you're in the general and or health space, as one example, or specialist insurers like medical insurance and so on, or professional indemnity insurance, there you're focused a lot more on the liquidity side. You have this regular claims experience coming through every year, and you have a bit more volatility in the claims experience coming through that you've got to be really ready for with your investment portfolio. So quite different considerations, both the type of insurer, the ownership structure, the product line, and then of course, market conditions themselves can change, but certainly the returns going forward. And from here, now that the whole risk curve is lifted, it's become a bit easier for insurers.
Yeah. So with the risk-free rates being now higher, does that also mean that the forward-looking returns are adjusted for insurers?
Yeah, we certainly think so. So if you sort of boil it down to the basics, the risk-free rates are ultimately what's used to discount liabilities for insurers, in particular if you're well matched. And if we just sort of touch on short tail insurers, previously you had short tail insurers, liabilities discounted by those risk-free rates, but the assets that you were purchasing on the other side, you really needed to take some alternate risks, whether it's lower credit quality or structured risk, for example, moving into securitized products or otherwise, or take some form of equity beta or some other beta or alternate risk to get a decent return. I mean, today you can quite comfortably build a asset portfolio that has a decent margin above the liability yield to maturity. And that margin is your profit buffer. Of course, that can be volatile in itself, but it's a more comfortable profit buffer. And both domestically and globally, we are finding that insurance companies in their investment portfolios have a healthier margin to work with. That's not to say that year to year it couldn't be up and down, but certainly a healthier margin to work with than they did through the last 3 or 4 years.
And that's one other unique thing of, I think, insurance investors. They always have to start with their liabilities rather than sort of the risk-free rate or just the return. But I think when interest rates were really low, we did see that some insurers, they moved away from like a really strict liability matching to a little bit more of an absolute return or a liability conscious approach. And in the survey, it showed that a majority is still more in the camp of liability conscious rather than matching. Do you think that's still a hangover of that period, or is that reflecting of the changes in investment approaches over time?
Yeah, it's a combination of both, and it's a really good question. It really depends on the nature of the insurer and the nature of the liabilities in the product line. So if you've got a long tail set of liabilities, under APRA's LAGIC standards, it's quite punitive not to be matched, at least at accrued level. And the more you can be matched and then take deliberate mismatches, whether it's on credit risk charge or, interest rate risk charge or inflation risk charge, it becomes punitive. And so the best outcomes that we see, both in the past and also going forward, is investment portfolios that are quite well matched, nice and tidy, and then taking intended mismatches where the return on capital is very attractive and efficient. Short tail liabilities, on the other hand, think health insurers, I mentioned before, business insurance, professional indemnity, general insurers, for example, they have been much more of what you just described as, liability conscious, and they've moved more and more to building portfolios that are absolute return or total return in nature with sufficient buffer to meet their claims, and then just having the appropriate liquidity requirements to meet the claims. And that's because the LAGIC capital impost isn't as big if you're less mismatched. Now, as I touched on earlier, for health insurers who've had more the equity risk beta, that's where they're probably recognizing now that the capital impost is too high. And so what we're likely to see going forward is not perhaps a full liability matching at the short tail end, but certainly a move to becoming much more liability conscious towards liability match, and then using fixed income and credit and investment grade credit in a heavier way at the expense of equities and other alternate assets.
The liability question is, it affects the long-term investment horizon of insurers sometimes. And I was thinking particularly about the example where sometimes, in periods of financial stress, insurers tend to sell their growth assets and they basically play it safe. And so they're kind of counter-cyclical in that sense where you think like, well, that's the time where you don't want to crystallize your losses, right? But for insurance, it's not always that straightforward. That's right, isn't it?
Yeah, you're absolutely right. I mean, if you're a traditional long-term investor, whether it's in pension or a personal investor, you can ride out cycles and go through cycles. But the whole capital framework for insurers and to some extent banks, but let's focus on insurance today, essentially means that the more downside volatility you experience in your asset portfolio, the more you're forced to de-risk the portfolio at, like you said, the absolute worst time, when you really want to be re-risking your portfolio. And the only way to do that is to apply either shareholder capital or government capital into the balance sheets of insurers, which is very hard to do from a pure investment perspective. Certainly it happens, and we've seen that happen, not long ago in Australia. Challenger raised equity at a time when their asset-backed security portfolio was being remarked downwards and so on. So we do definitely see these examples in publicly listed companies, but much harder to do if you're a subsidiary or a local branch of a foreign insurer and or a government insurer and the like.
Let's touch briefly on ESG considerations, environmental, social and governance issues. The survey found that most of the insurers, or a lot of them, are implementing these considerations in their portfolios now. But what I found interesting is that life insurers tend to do less of that than general insurers. While when you look at sort of the time horizon that they have, you would think life insurers would be more aware of sort of these long trend, long horizon issues. What do you make of that?
Yeah, I suppose for insurers, the considerations around ESG is threefold. Firstly, it's directly on their operations and the impact on their policies. So, clearly flooding and or bushfires or hail damage to, motor vehicles is a much more direct claims impact. And so taking that into account, so for example, some insurers are very good at identifying postcode by postcode, flood risks, fire risks, hazards, even hail risks, etc. So that's partly why you generally find that general insurance tend to be more focused in that particular area. The second part is on the impact of the performance of their assets, whether it's technical reserves or shareholder assets. And that tends to be a little bit more longer term in nature. So if you're not buying very long-term assets, that can take a little bit longer to play out. So let me give you an example. If you buy today some coal infrastructure, whether it's a railway to a coal mining or a terminal, what you're really dealing with there is stranded asset risk in 10 or 20 year or 30 years time. You're not really dealing with any major risks from a year one or year two perspective. So it requires a much longer, time horizon. What is more obvious in investment portfolios is what we would call, social license to operate. So think about, gaming license operators or tobacco distributors or, companies like that. And so what we're seeing is that insurers are starting to become quite engaged on their asset portfolios. And to give you a couple of examples, we've implemented on behalf of our insurance clients over the last 3 or 4 years, tobacco-free portfolios and signatories to that. The second one is around, looking at carbon reduction in their portfolio and carbon intensity reduction, and not necessarily 2050 type targets, but interim targets. So one example, if I can share with you, is 2019 as a base level, and then a target by X% by 2025. So that's an example of that carbon transition pathway. And then further than that, we're certainly engaging with our insurance clients on, aspects like plastic packaging, diversity of the employees of, the companies that they invest in and so on. So they're certainly becoming more attuned. I guess the main difference between a wealth management or superannuation investor versus an insurer is that the wealth manager or superannuation, it is the member's money, and they're really trying to showcase that they're thinking about the member. In fact, through the surveys that they're conducting with their members, the members are saying, hey, I want my capital to do well, but also do good. Whereas on the insurance side, it is at the corporate level, and it's the company's balance sheet that's being invested as opposed to members. It's more the policy holders are different to the owner of the assets.
Yeah. Yeah, different situation. Another thing that is popular these days is artificial intelligence and how that can be applied. And the survey found that no less than 74% of respondents would start a trial for artificial intelligence in the investment management function over the next 12 months. That sounds very high.
Yes. Artificial intelligence is a fancy word for really the further adaptation of technology to undertake our processes. So, everyone thinks about, artificial intelligence. Does that mean these computers or robots are running insurers going forward? Maybe the case in a long time from now, but the immediate application is really around processes. So whether it's, claims, experience, underwriting, etc., can we use script and data to get better at that? Can we run processes quicker, using artificial intelligence or effectively some form of computing support? I'll give you a very quick example from a, investor perspective and, managing portfolios as an example. Like many organizations, there are many compliance rules and compliance documents to check before you undertake a particular investment. Now, using a very good technology script, you can actually place a trade that you're intending to make and then very quickly check 80 plus documents to make sure that you are within guidelines and within the right to place that trade using, technology, which a decade ago, you would have one person reading through these, checking with the compliance department and so on. So, artificial intelligence, fancy word, but it's here to stay, and it's going to really enable all these institutions, including insurers, to both operate better, more efficiently, more leanly, and also reduce costs when it comes to both the underwriting side, the claims side, as well as the asset portfolio or investment portfolio side.
Yeah. So I read a report from, I think it was last month, where they used ChatGPT 4 and 3.5 or 3.5 to basically invest in stocks using sort of sentiment analysis. And they found that it worked pretty reasonable compared to sort of earlier iterations. That's not really what insurers are looking at, though, is it?
Look, I wouldn't have thought so in the first instance. Where it can be quite useful is, for example, assisting with, and I do emphasize the word assisting with, as opposed to replacing humans in terms of, credit analysis, data gathering, information gathering, and so on. There's definitely a strong case to be made to gather data very quickly. And of course, as you know, software like ChatGPT and many others, they are basically gathering information that's publicly available on the web or other sources. And what insurers have is an incredible amount of data, actuarial data, claims experience data, and of course, the investment departments and or fund managers like us who manage money on behalf of insurers have an enormous amount of market-related data, whether it's credit spreads, defaults, interest rates, swaps, and so on. So to gather and manipulate and use this data for decision making, if it can be done in an efficient way, that will certainly help the whole process.
Yeah. Do you use AI in your own area in fixed income investing?
We are certainly exploring how we can enable some of our analysis and data gathering and really the broader extension of analytical frameworks for investment decision making. We have models that we use, we have risk systems that we use, and we have some automated process that assist with that. I wouldn't call it necessarily AI. Let's call it AI 0.1, and we'll see if we can head towards AI 1.0.
Fair enough. So Jay, what is Janus Henderson's experience working with insurance clients? We just discussed that there's quite a few differences. How do you look at that?
Yeah, here in Australia, Walter, Janus Henderson's got significant experience in managing insurance-related products and portfolios across life, health, general reinsurers. And today we manage about $11 billion of insurance-related assets. And that number is about $86 billion that we're managing globally on behalf of insurers. We do understand that, managing assets for insurers requires quite a different level of understanding of the unique position of each insurer, its ownership structure, the types of products it offers, and then also the liability structure. So it's definitely not a one-size-fits-all approach. And then undertaking active management can really assist with, enhancing profit for insurers.
And finally, do you have any sort of comments or things that you would like to add about the survey?
Yes, I think the most important thing for insurers is that the economic, global, and market landscape has shifted quite considerably. And so the playbook of the last 3, 4, 5, or even the 10-year period of the past is probably not what's going to suit insurers best. We do also have a few things occurring locally here in terms of health insurers moving on to LAGIC. And so focusing on the marriage of investment market returns on a forward-looking basis with APRA's LAGIC standards and other regulatory requirements, liquidity requirements, and so on, and then building custom solutions that really fit neatly with that will probably drive strategic asset allocation and also the types of portfolios that insurance will have going forward.
Yeah, excellent. Well, Jay, thank you very much for your time. It was a very interesting discussion.
Thanks, Walter. It's been a real pleasure.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.